Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Jason Hull of Broadtree Partners. Jason, thank you for joining us.
Hey, thanks for having me. Glad to be on.
Great. So what was your background before starting to work with early stage companies? What led you to where you are today?
So I took a very different route than most investors or even entrepreneurs. I was in the Army. So I drove tanks and ran stuff over. And then I went to business school. I came out of business school. I had the entrepreneurship bug. University of Virginia is where I went to business school. But I figured no one would back someone who had just been a tanker, went to business school. So I probably needed to go get some real world experience. So I worked at Capital One for a couple of years and then started a software company with a couple of buddies of mine. We each pitched in $400 as our seed capital. And 5.5 years later, I was lucky enough to have an exit. Did a couple more startup type ventures and then got connected with my co-founder, David Slenzak, through our alumni network at Virginia, because I had seen what it was like to sell a company and how, even though I supposedly was a somewhat educated person, having somehow dodged through all the nets at the University of Virginia, I really didn't know what I was doing when it came to actually having an exit event. And I think that there are a lot of founders of companies who are very technically minded, who don't realize how they can get off the ride when they're ready to do so, or they feel like they've taken it as far as they can get. They just want to go back and build widgets or get back into the code. And they don't know how to do that because now they're running this organization of 80 people and can't get back to the thing that they're passionate about. And so that to me is what we try and solve, even though, yes, we work for our investors first and foremost. What we're really trying to do is solve the problem for business owners who are looking for liquidity events and who are looking to bring in someone who can help them really realize the vision of their company or to allow them to get off the ride. So long answer to a short question.
Well, great. That's a definite need in the marketplace. There are many companies that aren't continuing the venture path and have to take other paths to the exit, and you provide a good one for them. So for those investors who are interested in this space, what's your advice for people that want to invest in the sector you're in?
So there are a lot of private equity firms that focus on what they call the middle market, which is generally, and I know different people have different interpretations, but generally call it 5 to 25 million EBITDA. And so depending on your risk tolerance and your risk appetite, and this is not investment advice, let's be clear, you may wind up going with those for kind of an established track record. A company will usually have a strong management team in place. And so there is a perceived lower risk and therefore lower beta in that market. But that's where a lot of the capital goes to. And so they wind up chasing opportunities and they're fighting against 25 of their closest friends at an auction in order to win those opportunities. What we focus on is the 1 to 5 million EBITDA space and what we call classically undermanaged companies. So if you are an investor who wants to get into the space, we think that there is potentially more upside because these companies are not run as efficiently as they could be. They're run by someone who puts in 20 hours a week and it just kind of runs itself. And they want to put in the effort to go from 2 million to 6 million EBITDA. Or they're technicians. They want to be in the code and they don't want to run a company. And so they've kind of hit their vertical limit. But in exchange, you have to be very comfortable with the fact that it's not going to look like a pretty company that you're used to investing in. So they're not going to be 10Ks. Most of these companies are not GAAP compliant. We have done quality of earnings where the seller said, hey, here's my login and password for my credit card and for my bank account. You go figure it out. And we had to rebuild income statements from 25,000 credit card transactions to 2,000 bank transactions for a 1 to 5 million EBITDA company. That is a lot of transactions. So if you're going to invest in the space, you have to understand that you're looking at a lot of potential. You're looking at companies that have gotten past the product market fit conundrum that you tend to see with Series A. So they've done something right because they have 1 to 5 million EBITDA. They usually have a history of profitability, but they aren't as well organized. They probably don't have all the right team in place. They certainly don't have the financial controls that you're used to seeing. And so you have to kind of open up your mind to understand that, yes, there are companies that are run by people who were really good at whatever they did and they built a company around it. And the financial and sometimes even the managerial aspects of these companies are not what they're used to seeing. And they have to be comfortable with understanding and accepting that risk in their investments.
Well, that's great. So you've seen this industry sector evolve. Where do you see it going? What are the changes you see in it so far?
So I think a couple of trends. So when we first came in, we got started really 3 years ago. And one of the questions that I asked my partner, Dave, is why aren't other people doing this? And the answer at the time was, and we asked a lot of river guides, like why is this such an unfished pond? And the answer was, well, if you're an investment bank and you're going to do a book and you're going to run a process, then the company has to be a certain size in order for you to get your management fee to make it worth your while. So there was a bottom limit to what investment bankers, transaction advisors were willing to do in order to market and do a sell side on a company. And then on the bottom end, you have business brokers who are not used to the level of complexity that 1 to 5 million EBITDA company has. So they're really good at selling daycare centers, nail salons, car washes, and that's great. We need people like that. And the barrier to entry there is you have a real estate license in those states. So the sophistication that you need in order to broker these companies is or was higher than what a typical realtor is going to understand. They're going to understand the building and the land in highest use, but they're not necessarily going to understand intangibles and cash flow. And then you've got banks who, again, come from kind of one of two worlds. Either it has to be big enough that they feel like they can attach and write a big enough debt check to make it worth their while. So the big companies that are publicly traded, the Bank of America, Chase, et cetera, have to do transaction financing, debt financing of a certain size. And then once you go down into maybe regional or local banks to do transaction financing, they're going to think of it like real estate. So they're going to say, where's the inventory? Where are the assets? Where's the building that I can attach to, that I can have some sort of lien against in order to do the acquisition financing? And they're not used to the idea of a lot of companies now have a lot of intangible assets. So a software company is not going to have a whole bunch of inventory sitting around that you can do an 85% ABL against. And so both of those aspects of the environment are changing. So you're seeing lower middle market private equity starting to dip below. So 3 years ago, were very few funds that we would run into that would go below 5 million EBITDA. Now you're seeing them dip all the way down to 2 million EBITDA. You're seeing banks that are willing to do cash flow lending, airball financing on $1.5 million EBITDA, 2 million EBITDA. And so it's no longer the realm of having to go non-traditional debt sources in order to get acquisition financing. And then on the transaction advisor side, you are seeing boutique transaction advisors that understand that you don't have to do a complete Merrill type of book or sell side process in order to be a transaction advisor, but you need to have a little bit more understanding of how businesses run that a realtor may or may not have. And so we're seeing more of the enablers of these transactions happening probably all the way down to 1.5 to 2 million in EBITDA. That doesn't mean that all the companies that could potentially be sold are receiving that level of service. So in our opinion, there are way more potential companies that could be bought and sold than there are buyers, than there are operators, and arguably than there are capital providers. So to me, it is still very much the realm of a proprietary transaction. 70% of our deal flow is proprietary. And that means it comes with its pros and its cons. The pro is we aren't fighting 25 of our closest friends to see who can be the high bidder. The con is sometimes you have varying levels of commitment to the sell process. So if I'm going to engage a transaction advisor, a business broker, an iBanker, I've got some level of commitment because of all the work that I have to do to put a book together. So you kind of know that they're in for a penny, they're in for a pound in terms of the sell process. Whereas if you just happen to be the first person that Joe the plumber has talked to about selling the company, you may get to the point where you've got documents ready and are saying, hey, Mr. and Ms. Seller, all you have to do is sign these documents. We do a call, we confirm all the capital, we wire you the money, and the transaction's done. And they get cold feet and they leave you at the altar. So that part, I don't think will change, in that this is still an emotional event for a lot of these sellers. These are founders generally, and they define who they are through what they do. And so when it comes to, it's sort of like if you have to sell the house that you grew up in or that you raised your kids in, you might know that you're getting a good price, but that doesn't mean that it's that easy. There's a lot of studies by Dan Ariely out of Duke, Adam Grant out of Wharton that talk about the emotional aspects of attachment to things. And a lot of business owners still have that attachment. No matter how much professionalism comes and encompasses all the other parts of doing a transaction, it's still a very emotional transaction for the seller when signing day comes.
Well, that's great. Well, you talked a little bit about your investment thesis, which companies you work with and how you came to it. But can you be more specific? What startups fit that thesis that you look for that they should approach you? And those who should not approach, what are the specific criteria?
So startups, we probably aren't going to really invest in. And I can get into one that we have acquired recently that I'm surprised didn't get venture capital backing. But we are looking for kind of established companies, 3 years of profitability, 15% plus EBITDA margins. Ideally, you've got 80% plus recurring revenue. And so startups, at least in my mind, a startup is, I've got an idea, I've got to get to product market fit, and I've got to get to scalability. So like you think of seed capital is establishment of maybe your prototype, your proof of concept, your MVC or your MVP. Once you get your MVP, your Series A is to get to product market fit, and then Series B and on is the scalability. So those companies, your investors, your VC investors are going to be looking for a certain type of exit criteria that probably is going to price you out of what we're willing to pay. So we tend to, generally speaking, pay 4 to 6 times EBITDA, previous year trailing 12-month EBITDA. And so a lot of VC investors, you're just not going to get the return that you're looking for as a VC investor if you wind up selling to someone like us. So for us, we tend to wind up being more founder-led. I built some stuff, I sold it, then I needed to hire someone, and all of a sudden I got 8 facilities and I'm ready to go off the ride. So, occasionally you do have companies. So the one that we wound up buying has a lot of recurring revenue, has a lot of contracts. It's a software as a service company. And it's great sellers. They're amazing. They're very technically competent. They're very relationship driven with their customers. And so one of our lead investors is actually a serial VC investor. And he kept saying, I'm surprised that VC has not gotten this company. And so occasionally we wind up in situations like that where a company would have profiled as a potential VC investment, but now they've kind of gotten, it's almost like they've gotten too big for VC. They're looking for someone that can help them really come in and run the company and scale it. Maybe they're looking to take chips off the table in a way that a VC investor would not allow them to do. Or maybe they want to get off the ride. Maybe they want to stay for a year, transition, and have someone else run. I think those are the companies that we wind up being drawn towards that may have a VC-esque profile, but aren't really VC-invested companies. We just tend to find that for where we play, if they have VC backing, their investors they still see that they're at the inflection point of the J curve, And so the returns that they're looking for are just not in line with what we typically pay. But there are growth equity places that they could potentially look at. But if they're in that kind of J curve pattern, I think that there probably are advisors that can help them out, that can help them find the right investors or buyers at that point.
Great. So what's an example of a startup that fits your thesis? If you just had to pick one, can you tell us a little bit about what they do and what the criteria is they have that meets your criteria?
So the one that we wound up closing on, they got their start. It was a couple that were very technically oriented. They had a prior customer when they'd been doing consulting work who said, "Hey, can you build this?" And it was a specific software as a service. And they said, "Yeah, we can do that." And then they realized pretty quickly that this is something that they could copy and paste and put in other customers. And they really just wanted to focus on customer relationships and on building great products and on delivering great customer outcomes, which generally speaking is what you want to do as a business owner. You want to deliver customer joy. And so that was what they were focused on. And they did just enough to kind of create a company and manage the ability to do that. But they didn't have a lot of intentionality and process around how they were building and scaling the company. And so I think they got to the point where they realized, hey, we're sitting on a really good opportunity here that could grow, but we really we're not sure how to do it. And we're not sure that we're the right people to do it. That it might be time to have professional management come in and provide the strategy, provide some of the tactics, provide some of the infrastructure and the frameworks to invest in that, to allow them to really focus on the product development and the relationship management, which is what they love. And they kind of, if you will, stumbled their way into significant profitability. And then we just happened to catch it. We just happened to reach out to them, right time, right place, right person. So it's kind of a mix. You have to be at the right place. And we as a group have to be in front of someone who would be willing to entertain that conversation at the time that we hit them. But their churn numbers were incredibly low. Their recurring revenue was extremely high. They had a lot of re-ups. They had some real lighthouse clients in a couple of different industries that were great reference clients. When the people at their clients would leave and go somewhere else, they would call this company up and say, "Hey, can you do the same thing now with this new company?" So that makes a great reference point. All their customers were really happy and said, "Hey, there are other things we'd love them to do if they could just get big enough and get scale to do that." And so I think they realized that challenge, and that's something that I think we are going to enable them to be able to accomplish.
Well, that sounds great. Well, I know there are many challenges in this space, but if you had to pick one, what would you think the main challenge you face and what you do there?
I think for us is helping sellers understand that this is not like selling your house. If you want to put your house on the market, you get a realtor, the realtor puts on MLS, they put a sign in front of your house, people drive by, you have to keep it clean for an open house. Someone gets you an offer, and then they do a mortgage process, and they get the mortgage, and then you sign a bunch of paperwork, and you move out, and they take your home. It's a lot more complicated to sell your company. There's going to be a very thorough examination of the company, the quality of earnings, which is designed to say, hey, you tell me you're a 2 million EBITDA company. Are you really a 2 million EBITDA company? Does everything in your books and in your bank statements and in your tax returns and in your contracts justify that? And are you really an ongoing concern with that ability to continue on the growth path that you're telling us you can go through? And then a legal diligence. Are you legal? What sort of contracts do you have? Can those contracts be assigned? What sort of employment contracts do you have? What will your employment or consulting agreement be going forward? It never goes as fast as you want. If you're bringing up bank for bank financing, they're going to go through their own diligence. They have their own timelines. There are humans at the end of all of these strings, and they are subject to their own foibles. We had a bank that had done a couple of deals with us, and we had one where the chief credit officer's brother had inherited a company, not brother, maybe a cousin relative had inherited a company that was just like that. And he struggled, and therefore our company was bad. And so they decided they weren't going to do it. So there are human beings at the end of all this. And so it will seem daunting. You'll get diligence checklists that seem like 50 miles long. And holy cow, how am I ever going to do this? Maybe I just run the company. And you get through it. It's a process. You just take it one at a time. You eat the elephant one bite at a time. And the dirty little secret is you could always run your company for another 2 years and come back and try and do it again. And so the question is that what you want to do? Is that how you want to spend your time? I think a lot of sellers discount the value of their time, that time is the most finite resource that they have. And at some point, you will get more value out of spending time with your family, out of pursuing your hobbies, out of going and traveling, doing whatever it is that you want, than showing up at the office again. And so for getting the sellers to understand that trade and where they want to be on whichever side of that trade they want to be on as quickly as possible is pretty challenging, because they tie their identities. A lot of them tie their identities to the companies that they built, and rightly so. They built a good company. They employ a lot of people. They do good in their community. They should be justifiably proud of that. So it's really a decision of, are they ready to transition, and kind of helping them think through that in as unbiased of a way as possible, because we don't want to waste their time and we don't want to waste our time if they're not ready to make that transition.
Great. So if you had to pick a couple of sectors out there today that you think are ripe for, or hot sectors, which ones would you choose?
So we're pretty industry agnostic. Where we really like to play is, and this isn't going to be a real specific answer for you, unfortunately, but we like to play in industries where there are tailwinds, where there's natural industry growth. We also like to play in industries that are not going to be hit very hard by what everyone thinks is a coming recession. So you don't want a highly cyclical company that got bushwhacked 75% of their revenue in the last recession. Or if you're going to do that, you've got to price it appropriately. If you're going to price it appropriately, your seller's going to tell you to go pound sand. So, we try and avoid those highly cyclical industries, which tends to also go hand in hand with the idea that you've got some industry tailwinds. It's easier to run a company when you got the wind at your back than it is to try and steal market share in a downturn, or steal mind share, market share, wallet share from a competitor. It's always easier to go out and get new customers that have never heard of you or your competitors, but have a need that you could solve, than it is to try and say, hey, I got a better search engine than Google. Why don't you try me? That's a very, very difficult company to run. And you're not going to, as a CEO, you're not going to wake up every morning going, hey, I can't wait to go fight Google. So, you got to think about, from an investor perspective, like, what is the day-to-day life of your CEO going to be like? And are they going to be as excited to wake up 3 years from now as they are on day one when they take over the company?
Well, great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
So in the companies that we buy, there is a transition period. And no matter how much diligence you can do, we've had our putative CEOs spend a month pretty much on site with companies, even sleeping in the basements of our sellers. And yet, once you're in the hot seat as a CEO, you find out, oh my gosh, there's all this other stuff I didn't know about that they could have never discovered in diligence. Your first 3 to 6 months as a CEO, you're really finding out what you bought. And so as an investor, if you're going to invest in this asset class, you have to be comfortable with the notion that in that first 3, 6, maybe even 12 months, there's going to be a lot of murkiness in the reporting of what you've got. You're generally trying to get your books to GAAP. There's revenue recognition. There's expense recognition. They may wind up, one of our portfolio companies will get invoices from their from their service providers and their vendors 4 or 6 months after they provide the service. And now you have to come back and make the adjustment. Eventually, you'll get the books in the place where you can forecast and project what your expenses are going to be. But in the interim, when you're working from a seller who says, hey, I had more cash this year than I had last year, so I'm doing something right, to try to get to a true GAAP compliant set of books that you can use to forecast and budget, there's going to be some murkiness. And so you're going to have some discomfort for the first 6, 12 months of going, what did I buy? How are you doing against last year? How are you doing against your SIM? How are you doing against your budget? And while your board's going to work to get that reporting capacity and understanding and compliance and measurement as quickly as they can, you've got to be comfortable with uncertainty until you can get all of those processes in place and a potentially variable hold period. These are illiquid assets. And so you have to be kind of flexible in how long you're willing to hold. So if you've got a fund with a very defined time period and return period, you may wind up in a position where you're having to liquidate these investments in an illiquid market at the wrong time and not in an optimal way. So your investment statements as you are raising capital, or your personal time period if you're investing your own capital, has to be such that you don't need that cash for quite a while. But if you're flexible and you're willing to deal with that, then you also are able to potentially buy companies that are undervalued. And if you can grow them, you not only get the benefit of a higher EBITDA multiple, of potentially some distributions later down the road, but also potentially some multiple expansion as you get into a more liquid set of buyers if you can break through some EBITDA thresholds that you're looking at. But this is not something that you should go into thinking, hey, I'm going to start getting dividend and distribution payments next year, because these companies are not designed to do that. These are companies that we're investing in because we see the growth potential. We need to reinvest to maximize that growth. And there will be some hiccups along the way because we're not buying shiny diamonds. We're buying a pile of rocks, and there's a really nice diamond in there somewhere.
Well, great. Well, how best for listeners to get back in touch with you?
You could go to our website, www.broadtreepartners.com, click on contact, and just fill out the contact information. I believe you'll have the link in the show notes.
Well, great. I'll put that in the show notes. Thank you for joining us today, and hope to have you back for a follow-up soon.
Yeah, my pleasure. Thanks a lot for having me on.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.